Very good evening, everybody. Welcome to the Saptakala Real Estate Law Journal. We'll be bringing you lot of knowledge, lot of news on real estate, on legal aspects, and various other things. Myself, Sanjay Chaturvedi, your host today, and I am going to save you with the today's knowledge series, or you can say a bundle of lecture on knowledge. And the burning topic which we are going to cover is the Union Budget in 2021. And in the Union Budget 2021, there were lot of uh, magnitude of financial aspects, industries, many other aspects which the current government has covered. Today we are having two learned faculties in the industry. Dr. Niranjan Hirandani going to give us his wisdom on the various aspects of the Union Budget 2021. And then there will be a detailed analysis by none other than Advocate Anil Harish. Advocate Anil Harish is going to enlighten us on various aspects of the financial aspects of the Union Budget 2021. And not only that, we will be having very in-depth analysis on the personal finance, on NRIs, on various budget proposals, and how and way this Union Budget is going to affect our life, very particularly in real estate, where we are looking forward to have a, you can say, a sort of reboot of the industry after the lockdown. So before I invite Dr. Niranjan Hirandani, I would like to bring some few very minor points or few very minor details on the budget, overall budget, where Union Budget 2021 has emphasized various aspects. I tell you, this was the first Union Budget which was absolutely digital Union Budget. You must have seen that our finance minister were reading from a digital device, and all the parliamentarians were not given the copy, but it was kept as a digital document on the uh, in the on the Lok Sabha. Many people have asked me to speak in Hindi also, तो मैं थोड़ा बहुत हिंदी भी बोलूँगा, थोड़ा बहुत इंग्लिश बोलूँगा, एंड बहुत सारी चीज़ें जो रियल एस्टेट से मुतल्लिक रखती हैं या रियल एस्टेट को लगती हैं. आई विल बी स्पीकिंग many things on and covering lot of. This show is a very interactive show. Is not a monotonous, or you can say one-sided lectures. You can ask your questions. I'm reading your right now reading your comments in the comment box. I will once the presentations are finished, I'll be asking the sir to answer various questions to be answered, which you are going to put in the chat box down below. Now, covering little bit of the Union Budget, I would say that this budget was a Atmanirbhar budget, actually. A Atmanirbhar budget, that means a step towards making India Atmanirbhar. आत्मनिर्भर भारत के लिए बहुत ये जरूरी था कि बहुत सारी ऐसी कुछ ड्यूटी लगाएं, इंपोर्ट ड्यूटीज लगाएं, बहुत सारे कुछ ऐसे कदम उठाएं जिससे कि मैन्युफैक्चरिंग यूनिट्स में या हमारे जो किसान हैं उनको थोड़ा सा सहूलियत मिले, हमारी मैन्युफैक्चरिंग यूनिट्स को सहूलियत मिले. So looking at various aspects which we are going to see in the analysis, this budget was actually a step towards Atmanirbhar Bharat. The first step, which I think is one of the biggest, you can say, after almost 11 5-year plans have gone, this was the first union budget which has gone, that is, which says that Jal Jeevan Mission. Now, Jal Jeevan Mission is the one, it is Jal Jeevan Mission for the urban centers, and allocation. When the government is looking at the inclusive development and development in all aspects, as far as the real estate is concerned, I tell you, water availability is one of the biggest criteria to develop real estate. Now, many Muflis areas, many outskirt areas, many suburban areas where many of the infrastructure is needed. One of the need is the water, and this union budget has actually identified that the need to provide water to all urban centers and urban agglomerations which are under the development mode right now. The Jal Jeevan Mission would actually boost the real estate sale, I tell you, because the moment there is a water in the particular area, one of the water is one of the criteria is that the whether I am getting a 24-hour water or no. So the government is going to provide one of the mission, that is Jal Jeevan Mission Urban, is what. Now, in the second aspect which the government has identified, which as far as, see, there was a very huge budget and there is many aspects of it, but I am concerned right now with the real estate and uh, uh, maybe directly or indirectly such type of steps which is directly or indirectly going to affect the real estate pricing would be water, infrastructure, and some other areas where I'm going to tell you. In two-tier city and the suburbans and outskirt areas of metro, the mega metro cities, the Metro Light and Metro Neo. These are the two aspects which the government has actually identified that they are going to connect thousands of kilometers of the two-tier and the suburban areas, like say for example Badlapur or maybe Palava or maybe Palghar or maybe in of outskirts of Delhi, maybe till Mathura, Kosi, Meerut. Now, such type of say places in NCR or in Ahmedabad, say maybe Sanand or maybe in Mehsana and some other places. Now, these are the areas where the affordable housing is taking place. The need for infrastructure there was needed. The moment there is a metro in such areas where the uh, infrastructure is needed, the metro line, that is in Metro Light and Metro Neo, would be going to enhance the value proposition in real estate, and I believe the demand will increase the moment there is a infrastructure such like a metro and other things. Then the finance minister has announced asset reconstruction company, which is to be managing the non-performing assets NPAs of the public sector banks. Now, this is one of the indirect support to real estate. Why? Because the asset reconstructions companies basically gives a financial viability and financial supports to the uh, bankers, non-banking financial institutions, people, those who are institutional financiers, those who are financing the real estate, either to retail finance or maybe in large or maybe financing developers, builders, or industries or whatever. So the assets reconstruction company, which is to be floated by the government, will be one of the boosts to give a support to the public sector banks where the NPAs are going to be treated. Then, for the first time, the government have identified that there is a need for research, and the government has given 50,000 crore rupees to national research foundations, which is with this allocation, I believe that, see, we want to know the demand assessment. See, we want to know that what is the demand in some particular areas. We want to know that what exactly would be the good use of that particular land, whether I should construct a residential project, or I should go for mall or IT company, or such type of thing. So if unless I know a good parameters, or I identified the growth drivers, only research can give us. So I believe that is a very good step the government has taken, that the National Research Foundation would give us a research, and there will be a boost in the private research also, where some of the researchers are going to give us some food for thought before we go into a large scale uh, big projects, either residential or commercial or any other real estate project. The next would be the era for securitization of real estate, where the real estate may be traded on the exchange traded browsers or wherever, where in the world the REITs, you must be knowing, real estate investment trust and infrastructure investment trust, are now getting momentum in India. For the first time now, the government had said that, with if you are receiving the dividends from the REITs, then you are not subject to, or maybe exempted, the TDS aspects, that the dividend is free from the TDS and you will be directly getting. A small investor like 5 lakh rupees or 10 lakh rupees, suppose is investing into the sectoral specific real estate trust, then in the real estate REITs, the government has said that the TDS is not going to be deducted from the dividend aspect. Now we are having the additional deduction, that is, I think our faculty advocate Anil Harish is going to take uh, in a detailed one, but I have to just mention this, that the additional reduction which we were getting it, now it is been extended for affordable housing in Prime Minister Awas Yojana, where a additional deduction of 1.5 lakh shall be available to the loan taken before 31st March 2022. So that is almost it was there, and the affordable housing is a need of the hour, and affordable housing must get some boost. Maybe the government is, of course, there was a lockdown and there are so many other industries to look after, but I believe that sooner or later the affordable housing units, which is less than 45 lakhs rupees, I believe so, also there in some of the outskirts of the um, mega metro cities, which is also going to be eligible for this. Now we are having um, a very special announcement by the finance minister, that is that the government is going to float a special purpose vehicle to monetize, or you can say demonetize, the land belongs to the public sector units. Now their large tract of land is there with the public sector units, including railways, maybe the units which are there, going to release the land for the development. I believe so. Land is the most important commodity as far as the real estate is concerned. When the land is going to be released in the open market after the monetization, and the SPV is already announced to release such type of land in the open market, I believe so that in the long run the price going to be corrected, maybe because of the land is released and the more scarce commodity for the real estate is been available in the market. So we have to wait and see that which are those land which is coming after the demonetization. NRI gets relief from the double taxation system and tax credits. I think that we are uh, in an era where we are having connected with the world. NRI coming with certain investments, there are repatriation norms also. But unfortunately, now the government of India has also now recognized the overseas citizens of India, OCI we call it. In the era of international trade and commerce, we are having now recognizing the need of an hour where a double taxation system where the NRIs are facing, sometimes the capital gain tax and sometimes there are other taxes are going to be taxed. Now we are going to have a double tax system now recognized. The tax credit would be given to the NRIs and the OCIs, wherein in the city of their origin or the country of their origin, they would then now be uh, putting whatever tax under maybe tax treaties or under maybe otherwise also. If they are paying tax, they will be getting the tax credits, and they will be more emphasis will be given by our panelists today in this moment. For now, we are now having the we are now having some few questions now, which I'm getting it, and I'm going to just read. For first question, I'm going to get is getting that how the real estate is going to affect, how the real estate is going to be affected today, and what is there in for the real estate in the unit budget. I will tell you that since the real estate is already affected by the personal finances and the funds which is pouring in directly or indirectly in real estate from either from the retailers, that means from the buyers, or from the institutional investors. After a regime of openness in the economy, the hedge funds or the institutional finance, very specifically foreign institutional financiers, are going to be there as a major player in the market. Then the insurance sector from 49 to 74% now been allowed as a FDI. The fund flow, of course, with some certain conditions, then I think so that there will be a uh, I think so there will be a huge professionalism which is going to be there as far as the real estate development is concerned. Affordable housing, yes, the affordable housing is already, we are having an affordable housing segments, but government had also now thought of that there are various small companies and a need for some compliance relaxation is should be given, which the government has already given. The small companies, those who are having turnover between 2 crore to 20 crore rupees, are being given relaxation and some relaxation in the tax audits also been given. Now, in tax audits, we are having, uh, I'm getting some questions also. I'll read them, read your questions to you before we start with our guest speakers today. Uh, 1 minute. नया साल कोविड-19 सर को बोलो ज्वाइन कर लीजिए ठीक है ना दोनों से नहीं दोनों ज्वाइन हो गए ओके now I will be requesting Dr. Hirandani to please enlighten us on wages. Dr. Hirandani, sir, sir, you are mute. Sir, you are mute, sir. Sir, you are mute.
Hello.
Okay. Yes, sir. Yes.
A very good afternoon to you, Mr. Sanjay Chaturvedi. My heartiest congratulations on arranging this get-together in terms of the budget immediately one day after the budget. I think that's the fastest I've ever seen. I'm really privileged to be on the panel along with Mr. Anil Harish over here. I think he's also here.
Yes, sir. He is joined.
Okay. I just want to share with you all that I started my life in professional career as a chartered accountant. And when I used to hear the budget speeches, I would hear a person called Mr. D.M. Harish. And I had always had the privilege of hearing him, and that is how I started life. And also the other interaction with Mr. Anil Harish's father, after whom the firm DM Harish and Company is now continues. And hence it's such a privilege to hear them. This followed, of course, by Mr. Anil Harish, and every single year I have, to the best of my ability, heard almost all the, discussions given by Anil Harish, especially when it's relating to real estate. Somehow or the other, Anil's insight into this subject is tremendous and far-sighted. Has also been able to give us a very good view in terms of the interactions, because his relationship with people dealing with property, people dealing with development, people dealing with various aspects of real estate is part of his great professional career, and his interactions with me have been always a learning for me. So I'm actually going to be more of a learner today from him and hearing him rather than me speak. But I'd like to touch a few of the overviews relating to the budget, and I'll give myself 5 minutes on that. The overview on the subject is extremely interesting. When the budget speech started and all the aspects of the budget were spoken by Honorable Finance Minister Nirmala Sitharamanji, I was quite amazed and afterwards a bit shocked. The reason is that many of the sectors that she talked about in terms of health, in terms of defense, in terms of infrastructure, in terms of water, which Sanjay Chaturvedi has talked about the infrastructure in terms of metro cities, of all the city infrastructure that is being built. I said, oh my God, now this is going to be ending up with a huge taxation bill, which will be borne by the entire economy. And then in between, she came up with disinvestment policies. And I was pretty taken aback because there are far reaching statements done by the Honorable Prime Minister. And obviously, without his consent, it could not have happened because she talks about disinvestment of two banks. There's just been a consolidation of banks, and now she's talking about disinvestments of two banks. She's also talking about disinvestments of insurance company. She's also talking about an IPO of LIC, and of course, airports and others had already, and Air India had already been announced earlier. This, together with other innovative ideas in terms of collection of monies, she saved our entire taxpayers people from adding more direct taxes. So I would love to hear what Mr. Anil Harish has to say in this regard. But I'm really presently happy because there were a lot of rumors talking about a COVID tax to come. There were a lot of rumors that some inheritance tax or death duties would come in. So there were a lot of rumors in this sense, especially because of the expenditure done during COVID times, the challenge which we face with China and other aspects of challenge which we see in industry. So I think the new trend which I see as far as this government is concerned has seen a 180% turn, where they are now looking at the innovative ideas and thoughts in terms of funding the economy. The second part of that is the fact that they have not bothered too much with the increase in deficit financing. This in normal times would have been very dangerous because it would have caused unnecessary inflation. But as we all know, during times of depression, this is the best way which can be done. I always give a relationship to Germany. Most of the people know the German autobahns are probably the best roads in the entire world in terms of highways and expressways. But those roads were not meant and created for cars. They were meant to fight the depression in Germany during the 30s. And that is how the roads were made. Of course, cars and buses and other things, transport do drive on that. And of course, it's one of the best roads in the world, which we all enjoy. But the purpose was to give employment and to see this change taking place. So I think I'm not going to dwell at all on the various issues because Mr. Sanjay Chaturvedi has already given an overview of a large number of matters. There are very, very interesting items which have come both in the budget speech and in terms of the idea thoughts. The only blessed thing that we have is that the tax is not increased. But I'm a little disappointed that I thought that the individual tax, which is at a maximum rate of 42%, should have seen some rationalization. Also, the fact that while in the case of corporates, the tax rate is 25%, but in the case of partnerships and LLPs, it's 35% plus something. So I think that's a challenge, which I was expecting the finance minister to correct, and we were able to do that. The other items are many as far as the budget is concerned, but today I would rather get to Mr. Anil Harish to give it. For me, this is a trend-setting budget. Probably the change in the pattern, and I can say in history will one day write that this was one of the times when Mr. Narendra Modi and with the finance minister has made a paradigm change in the way in which the government will work in terms of finances, namely work towards various other items of income which are not related to directly to taxes. The last point is the fact that in spite of COVID, in the last 2 months, the indirect taxes has seen a boost, which is more than 1,20,000 crores in January of 2021. I think this is a fantastic sign, unbelievable, and we can see that part of it. And of course, the fact that Maharashtra government has done a super job in terms of stamp duties and other charges, which are also going to be extremely beneficial to them. But I'm so hungry to hear what Mr. Anil Harish has to say. I've said enough yesterday on various programs that came on TV and other notes and also in the press. So I would now look forward to hear from Mr. Anil Harish. It's such a pleasure to be here. But I can tell you, this is one of the most path-changing budgets that I have seen, probably as much as 1991, or may not be as strong, but certainly as far as Mr. Narendra Modi is concerned, I would consider it as a rightist budget, and really a different thought process has been put in order to make things happen. Thank you very much. Looking forward to hear from Anil.
I believe that is the bottom line of the budget. You are absolutely right, sir. We will be with us. We will be now having none other than Advocate Anil Harish. Sir, all yours.
Good evening, and thank you very much for having me here. It's such a pleasure to be on the same platform as Dr. Niranjan Hiranandani, and I often hear him at our different programs on the trusts and otherwise, and it's always very interesting. And with Dr. Sanjay Chaturvedi, it's both of you have done your PhD. So if anyone were to look at the lineup for this program, they would think it's a medical program. But in fact, of course, it's a real estate program. This year has been so different from anything that we have ever seen, with the pandemic, the lockdown, and yet the tax laws continue and finances have always to be very important. There was so much loss of business activity during this year, and the government has to make up for it now. The announcements by the finance minister have been at a level where not really directly related to the taxes, but the outlay of funds, because the budget is actually supposed to be relating to allocations and concentration on areas which need development. Taxes are a means of raising revenue, and there have not been very many changes in that. But some of the things that the finance minister talked about, as Dr. Niranjan Hiranandani said just now, about the infrastructure, about roads. They've talked about developing so many more roads of so many kilometers per day all over the country. That's going to be a game changer. We have seen that there have been pockets of great density of population, Mumbai and the other cities. But we need development to go all over India. And urban development must mean the development of new urban areas, not the further development of existing urban areas. That will happen with roads, as it has to some extent already happened with telecommunications. Then the government proposes to disinvest the banks and Air India. Of course, this is something that has been going on for a long time, for about 20 years, and the government has not actually raised so much. But let us hope that this is a time when they feel the need to do so, because there is not that much revenue coming from taxes, from direct taxes and so on, because so many people have been affected. Therefore, these aspects of the economy on which the finance minister has dwelt are going to be very important. But we also have to consider the changes to the Income Tax Act and to the other laws, to the fiscal laws, insofar as they affect us. As Dr. Hiranandani said, one of the biggest changes for real estate was the fact that stamp duty was reduced by the Maharashtra government. And I think this is something that the central government should have done, but they did not do during the lockdown period. They could have, for instance, reduced the GST. That would have given some boost to the real estate sector. But they did not do so. And it is the Maharashtra government that reduced the rate of stamp duty to 2% before in Mumbai, for instance, up to 31st December, and now to 3% up to 31st March. And then, of course, it'll go back to 5%. Also, the cost of premiums has come down, and I'm sure many developers would be able to take advantage of that. There have been many changes to the tax laws, not only during the budget last year, but there was again another amendment to the laws, and that was on 22nd September 2020, when there was a new act called the Taxation and Other Laws Relaxation and Amendment of Certain Provisions Act 2020. It didn't make many changes, but it did make some changes to the definition of non-resident and so on. But that is one law that there was. Now the finance bill, which covers many different laws, but we will now today talk about direct tax, which means the income tax, has as many as 78 clauses affecting the Income Tax Act. I will just do a screen sharing so that I can put up a PowerPoint presentation. And I hope that you can hear clearly. So there are 78 clauses relating to income tax in this year. Some are retrospective. Unfortunately, that is the way we've always seen it, that the government doesn't always do things prospectively. They do it retrospect. Sometimes it's helpful, sometimes it's not helpful. It has created a lot of problems for India in terms of Vodafone issues in the past and so on. But the stated objectives of the changes to the law are tax incentives, removing difficulties faced by taxpayers, and rationalization of various provisions. There are very few amendments relating to real estate, major at all. As Dr. Hiranandani said, and very rightly, there should have been a reduction in the tax rates for individuals, because a rate of 42.74% is extremely high, especially compared to a rate of approximately 25% for companies and 35% for partnerships and LLPs. But we would have thought that not only the rates should have come down, but there should have been something more for real estate, because it has always been said that real estate is such a big employment generator, and any amount spent on the real estate industry has so much downstream effect on the persons employed, and real estate is one of the largest employers in the country, and also on the consumers. But what has been done in terms of real estate is very little. One of the amendments is that Section 80EEA gives a deduction of 1,50,000 rupees for interest for a residential house, but that is only for small houses where the stamp duty value does not exceed 45 lakhs of rupees, and the assessee should not own any residential house property. This was in relation to loans that were sanctioned up to 31st March 2021, and now this has been extended only for 1 year. I think that should have been done. It should have been much more. Firstly, the costs have risen. So 45 lakhs is a low figure, especially for the major cities where there is so much density of population. Secondly, it is not that the housing shortage is going to get over by March 22. There is so much more need for housing that a provision like this should be a permanent provision and not just extended for 1 year at a time. But nevertheless, this is what it is. There is also an incentive for affordable rental housing, which says that Section 80 IBA provides for 100% exemptions from the profits of an affordable housing project and for an affordable rental housing project. Here also, the change is going to be for 1 year only, that the tax benefits will be available provided the approval is granted by March 22. Here, that should also have been a much longer extension that they had given. Now, this is an important provision. This says this is increase in safe harbor limit of 10% for home buyers and real estate developers. Under Section 43CA of the Income Tax Act, when a developer sells a property, In the event the reckoner value, the stamp duty ready reckoner value, is higher than the selling price, then the developer would have to pay tax on the reckoner value or on the transaction value, whichever is higher. A few years ago, they said that they would give a margin, first of 5%, then of 10% from the reckoner value. So, for instance, if a transaction price was a crore of rupees, but if the reckoner value was, let's say, 1 crore 9 lakhs or 1 crore 10 lakhs, then although stamp duty would have to be paid on 1 crore 10 lakhs, which is the reckoner value, the income tax could still be paid only on that 1 crore, and that 10 lakhs would not be deemed to be income, even though it was below the reckoner value. This is called the safe harbor of 10%. This has now been amended, but only for certain limited purposes, and that is that the safe harbor will increase from 10% to 20%. So, if your transaction value is 1 crore of rupees and the developer and the reckoner value is, let's say, 1 crore and 20 lakhs of rupees, so there's a 20 lakh difference in this example, still, although the stamp duty will be paid 1 crore 20 lakhs, the income tax will not step into the picture and will not work out in the hands of the developer, nor will it work out deemed income in the hands of the purchaser under Section 56(2)(10). This is helpful because the reckoner values are high in places, and because there is a lot of stock lying with some developers who have been affected by the pandemic, who have not been able to raise funds or not been able to complete, not been able to get. Therefore, this makes a difference. Otherwise, the tax was crippling. But this is for a very limited period, the same increase of this. It's only from 12th November 2020 to 30th June 2021. Well, today we're already on the 2nd of February and on the 1st. So therefore, in a sense, this is retrospective. It's beneficial, but the full impact of this has not been. This should have been continued for much longer. It's fine to begin it from 12th November 2020, but it should not be only up to 30th June 2021. At least it should have been for the full year. This also affects only those flats where the consideration does not exceed 2 crores of rupees. And if this is of this value, then they can go ahead and complete the transaction within the safe harbor limits, and the buyer also does not have a tax liability under Section 56(2)(10). Now, apart from these provisions on directly concerned real estate, there are, of course, a number of other provisions in the Income Tax Act. Some will affect, not significantly, but will affect developers and real estate and all other businesses as well. Section 206AB is to be introduced, and this relates to TDS. This says that if a payee does not file tax returns, then for 2 years before the transaction, then the TDS rate will be increased. Let me take an example in relation to real estate. Under Section 194IA of the Income Tax Act, suppose a person is selling a flat or selling a property for more than 50 lakhs of rupees, for example, for 60 lakhs. Buyer is required to deduct income tax at source. The TD 1% presently been reduced to 0.75%. But suppose that the seller had not filed his tax returns. Let's say this doesn't have much other income, but he's got a flat of 60 lakhs of rupees and he wants to sell it right now. He has not filed returns for the last 2 or 3 years because he didn't have taxable income, and he wants to sell the property to get money and so on. Although the normal rate of TDS is 0.75%, if he has not filed his tax returns for the last 2 years, though he was not required to file, then this new provision will say that the rate of TDS will be twice the relevant provision. So in the case of Section 194IA, it would be at the rate of 1.5% or 2%, perhaps in future, or it can even be as much as 5%, because it is the highest of the following. So if a person is going to sell a flat and has not filed returns for the last 2 or 3 years, then it would be advisable for him to actually file a return for the preceding year, even though he doesn't need to, even though he didn't have taxable income. He should file his return for the preceding year so that the TDS will not be at this higher rate provided in Section 206AB, but it will be on the basis of the normal rate under Section 194IA. In the same way, there are other provisions relating to TDS, and this will apply to many of them, not to all of them. Everything that I'm saying is on a brief and on a macro basis. You must look at all the provisions in greater detail if any of them affect you. Now, this also may apply to real estate and to other businesses. This says that there will be now a TDS on purchase of goods. Up to now, TDS has not been generally on the purchase of goods. It has been usually for services. That if, for instance, a developer pays an architect or pays a chartered accountant to deduct tax at source. If he had to pay for a contract being done, then under Section 194C, he would have to do TDS for the contractor, but not usually on the purchase of goods. Goods are subject to GST, etc., and there wasn't a TDS. But now, TDS will be applicable even to purchase of goods. However, it will apply only in a few situations. The rate of TDS will be 0.1% only, not a substantial sum, and this will apply only to a business which has turnover of more than 10 crores of rupees in the preceding financial year, and will apply to purchase of more than 50 lakhs of rupees in a year. So if, for instance, a developer is buying steel and the cost of steel is more than 50 lakhs of rupees in the year, then even though he's paying everything by check, even though there is GST, everything is done properly, he will still have to aggregate purchases from a particular steel supplier in the year, and in the event it crosses 50 lakhs of rupees in that year, then he will have to do a TDS of 0.1%. So everyone will have to recalibrate their accounting systems and their computer systems to see that if they are purchasing goods from a person for more than 50 lakhs a year, there will be a TDS. This will also apply, of course, to other businesses where persons buy goods and then sell them to traders, to manufacturers, in addition to those in the real estate business. So one does have to be very careful about this and be very vigilant that one complies with the law in all aspects. Now, Section 45(4) is an important section in relation to real estate, and some amendments are to be made now to Section 45(4), and a new subsection 4A is to be inserted. Section 45(4), as it stands now, since 1988, with a few amendments in between, is that when a partnership firm is dissolved, then the market value of the assets will be considered, and it will be deemed as if the firm has sold the assets. So let's take an example. Suppose there's a partnership firm with two partners, A and B, and they have two flats or two properties in the firm, flat 1 and flat 2. Now, if the firm is dissolved and A takes flat 1 and partner B takes flat number 2, they may think, well, we had bought these flats for 10 lakhs of rupees each. Today, the value is 1 crore of rupees each. We are only just taking out whatever was there in the firm which we had contributed for. It was our decision. We are not getting anything new. But no, that's not so. Section 45(4) says that you would have to pay tax on the value of the property that you take out, less your capital contribution to the firm. So if you put in 10 lakhs of rupees and bought the flats for 10 lakhs each, and they had gone up to 1 crore of rupees each, and now the firm is being dissolved, then the firm would have to pay tax on that capital gain of 90 lakhs plus 90 lakhs. That means 1 crore 80 lakhs if the property is a capital asset. What some people were doing was that before the dissolution of the firm, they would devalue the asset. So knowing that the market value had gone up to 1 crore of rupees for each flat in this example, they would do a revaluation. And in the balance sheet, they would increase the value of the asset and they would increase the capital on the other side. So balance sheet would show 10 lakhs on the asset side and 10 lakhs on the liabilities side, would now show 1 crore on the asset side and 1 crore on the liability side for each of the partners. And then when they took out the asset, which was worth 1 crore of rupees, then they would say we don't have to pay any tax at all because we've got a credit balance of 1 crore and we are taking out an asset of 1 crore of rupees. There have been some decisions of the courts also to say that this would not be taxable in their hands. But now Section 45(4) is to be amended to say that the revaluation of this nature will be ignored and the firm will have to pay tax on the value of the assets which go out from the firm, either in the case of a dissolution or even in the case of a reconstitution of a firm. And there is a new subsection 4A to be inserted, which says that there will be a tax on the partner. So if a partner had put in 10 lakhs of rupees and is now taking out an asset which is worth 1 crore, he would have to pay a capital gains tax on 90 lakhs of rupees. Of course, once he does that, then the cost in his hands or the deemed cost in his hands is 1 crore of rupees, so that if he turns around and sells a flat for 1 crore and 5 lakhs, he'll only have to pay tax on that extra 5 lakhs because he's already paid tax on the 90 lakhs. So this is important, and one does have to remember this in the event that there is a reconstitution of a firm or a dissolution of the firm and one is going to take out assets or even money from the firm in these situations. As was mentioned by Dr. Sanjay Chaturvedi, on tax audits, the limit has been raised from 5 crores of rupees to 10 crores of rupees for businesses, provided that the receipts in cash were only up to 5% and the payments in cash were up to 5%. All the rest has to be by checks or by digital means, by credit cards or electronic transfers, etc. So now this will mean that many businesses can go out of the tax audit net. This does not, however, apply to the professions. The limit for a professional was only 50 lakhs of rupees, and above that is subject to tax audit. That has not changed, even though the profession continues to do all its transactions mainly by check. This will apply only to businesses. When Section 234C and 4A and B were introduced in the Income Tax Act with effect from assessment year 89-90, then the advance tax provisions were that one would have to pay advance tax right from September, December, March onwards, although which later became June, September, December, March. But at that time, in 1989 itself, they made an exception. And they said we cannot predict a capital gain. It may happen anytime during the year. As long as you pay your advance tax on the capital gain after you have made the capital gain, then you will not have to pay interest under Section 234C on the installments before the date of the capital, because you could not predict it. Even though you can't actually predict your business income, they feel that there's a greater regularity in business income and therefore has to be paid even though you don't actually know the figures till the end of the year. So suppose a person were to make a capital gain on the 20th of December, then he will not be charged interest on account of shortfall in TDA on advance tax for the June installment, the September and the December installment, as long as he pays the advance tax by 15th March. This is now being extended to dividend, because dividend is now taxable in the hands of the recipient. It is no longer a dividend distribution tax as it was for a number of years. So if, for instance, a company declares a dividend today on the 2nd of February, you could not predict that. It was not within your control. You could not direct when the company would, especially in the case of public companies, you could not direct when the company would declare a dividend, and therefore you were up to now liable to pay interest under Section 234C on the shortfall in advance tax. But now this is going to be amended to say that the dividend will be on par with capital gains and you will only have to pay advance tax after the dividend has been received. So this is a good provision and will help a lot to avoid these uncertainties of having to pay calculation of advance tax. But please note that this does not apply to a deemed dividend. What is deemed dividend? Well, that is a loan given by a private limited company or a closely held company to a substantial shareholder under Section 222C and 222E of the Income Tax Act. So you must be careful. Do not take loans from a private limited company of which you are a substantial shareholder, if the company has reserves, you can have a big tax liability on that. And also you will have to pay the tax on the dividend by way of advance tax, even though you may take the loan in the latter part of the year. There have been many amendments to the dates for filing of returns, belated returns, revised returns, and the assessment, etc. This is an amendment which is clarificatory. So it says that if a person is a partner of a firm which has to do a tax audit or which has to do a transfer pricing audit, and the firm, for instance, has to file its return by 31st November, then the individual who is a partner of the firm cannot be expected to calculate his own income unless he's got the figures from the firm. So therefore, the first part of this amendment is that if the firm has time up to, say, 30th September in order to file a return, then the individual also have time up to 30th September. If the firm has time up to 30th November, then the individual will also have time up to 30th November. Likewise, in the case of people who live in Goa, who are still governed by the Portuguese Civil Code, and where there is a pooling of income between husband and wife. So if the husband has time up to, say, 30th November to file his return, then the wife time, because her income is dependent on his, because there's a pooling, and the income will be divided in two hands. So then there's an extension, and one can look at this if you're a partner of a firm, if there is a different time applicable to filing of returns or connected. Now, apart from this extension of time, they also talk about belated returns or revised returns. Up to now, you could file a revised return before the end of the assessment year. But they say that with the massive technological upgrade in the department, taken to conduct and complete such processes has greatly reduced. Well, the department has done a big technological upgrade. That is true. But they are now reducing the time within which you yourself as an assessee can file a revised return. And therefore, in the case that we talked of just now, of a person who is a partner of a firm with transfer pricing audit, and the firm has time up to 30th November, so the individual also has time up to 30th November. If he wants to file a revision, don't do it only by 31st December. So he gets only 1 month and not even till the end of the assessment year. So one has to be very careful. Please do it right the first time. Don't think that you will plan for a time may be very short. In the case of defective returns, under Section 139(9), the board has now the facility in genuine cases. In the case of reopening of cases and search assessments, there have also been some changes. The Income Tax Act has been amended from time to time. There was, in the case of search cases, formerly the concept of a block assessment, that they would say allocate income which is found in the course of a search to any particular year, because it's in the nature of it, if it was black money or a person had undisclosed income, they could not relate it to a particular year. So they had a block assessment. Then after that, they changed the procedure again. Now, they have admitted that those systems were a failure, and now they will have the right to, they will have a different set of provisions, cases, and for reopening. But a reopening now will generally be only within 3 years from the end of the assessment year, unless the income that is concealed or that the ITU feels is concealed is much higher, in which case it can be as much as 10 years. The new time limits will not apply to a search or requisition initiated on or before 31st March 21. There is another change where they talk about on account of the technological upgrade that the department has been undergoing. The time for completing assessments will now be 9 months from the end of the assessment year, from assessment year 2021-22 onwards, which means that if you file your tax return in July 21 or in September 21 or in November 21, then the ITO has to complete the assessment by December 22. That means 9 months from the end of the assessment year. So you don't have to wait too long. Earlier, it used to be 2 years from the end of the assessment year or 3 years from the end of the assessment. One had to have all that information available, and you never knew when the assessment was going to come up because there was such a long time. You would have to keep all your materials and papers for very long. Now, the assessments will be completed much quicker than before. There is the kind of investment called ULIP, Unit Linked Insurance Plan. Under this, what many assessees have been doing is that they would invest a certain amount in ULIP, and then when the policy matured, then they would get a substantial amount together with the appreciation and premium. And the entire amount was exempted from tax under Section 10(10)(d). But now in the budget it is stated this was not intended as a benefit to people in the highest brackets, and therefore in the past, if a person, for instance, had a substantial income, and let's say it's of rupees into ULIP as a premium in a particular year, he may get a deduction under Section 80C only to the extent of 1,50,000 rupees in that year. So he would not get a deduction for 10 lakhs, he'd only get it for 1,50,000. But if he paid 10 lakhs each year for a number of years, let's say for 10 years, and then when the policy matured and he got back not the 1 crore that he had invested, but let's say he got 2 crores and 50 lakhs of rupees, then that 1 crore 50 lakhs would be exempted from tax under Section 10(10)(d). Now they're limiting this, and they say that if the premium exceeds 2,50,000 rupees a year, then you will not get tax exemption in respect of the excess that you get on redemption with reference to that 2,50,000. So you will get the tax exemption only to the extent it relates to the 2,50,000 rupees per year paid by way of premium. And also, a ULIP will now be treated as a capital asset. So if, for instance, wait for redemption, but you sell it or you transfer it to someone during the existence or subsistence of the policy, and you get more than you had invested, then this amount will also be taxable because it is now treated as a capital asset under Section 214. This may not apply to everyone, but to those whom it does apply, it can be very significant. So do be careful of this. Under Section 142(1), at present, only the assessing officer can issue a notice. Now, other income tax authorities will also be permitted to do so, to call upon an assessee to submit a return when he is not acting. The concept of faceless assessment has already been introduced a couple of years ago. And I think that on the whole, it has been working well, because you will get a notice from an officer from any part of the country. He has to articulate his questions very carefully and set them out, and you get time to reply. Everything is in writing because you get a notice electronically by email, and you reply to that also electronically. You do not have to appear before the officer. And I've seen in many cases that when you get clear questions and you give clear replies, then the matter goes through well, and you can get a favorable order without having to have met the officer at all, and without there being much subjectivity in the process. But the question of appeals is something different. Now they want to make even appeals faceless. Now, if everything were to be faceless, if we were to live only in a world in which everything had to be done in writing, I would not be speaking to you right now. I'd only give you a paper and you'd be reading it. So therefore, faceless proceedings are not always useful. Sometimes you need to have a proper hearing, and you need to be able to hear the other person's point of view, especially when the facts are on record to a substantial extent through the faceless assessment proceedings or even through a first appeal, and at the stage of the second appeal, because the ITAT is a final fact-finding authority. And after that, cases will go to the High Court and to the Supreme Court. But in spite of that, they want to make hearings before the ITAT also faceless. I think that would not be right, because there are many nuances which can be brought out in a personal hearing, and clarifications can be given, questions can be asked, the tribunal members' doubts can be then the assessee's representative, and there can be a greater efficiency in completing the matter. Now, Section 255 is to be amended to say that this is to impart greater efficiency, transparency, and accountability by A, eliminating the interface between the ITAT and parties, B, optimizing utilization of the resources, and C, introducing an appellate system with a dynamic jurisdiction. So this would mean that a person from any part of the country can consider appeals from any other part of the country. So an appeal filed in Mumbai can be heard by an officer, by a tribunal member in Chennai or in Assam or anywhere else. But as I said, I think that this is not good. It's fine for the first level and the second level, but at least at the tribunal stage, I feel that there should be hearings. It may be faceless in the sense that they often may not be able to see your face in the course of a video hearing, but he should at least be able to hear you. So it should not be hearingless, it could be faceless. But we don't want it to be absolutely on paper or just in writing, because so much more can be brought out personally and by arguments. I think often of the decision of the Supreme Court in Keshavanand Bharati's case in 1973, where Mr. Palkiwala laid down the concept of the basic structure of the Constitution, and this was accepted by the Supreme Court through numerous judgments. Something like that could not have been done by just arguments that were in writing. It would not have been appreciated, it would not have been elaborated in the way that it could be done personally. So I think that this is something that they need to review. The Income Tax Settlement Commission has been in existence for many years and is to take up cases where there have been disputes between the assessee, where there have been law, and instead of the assessee going up in appeal through the various levels to the CIT appeals, tribunal, high court, Supreme Court, and with possibilities of a set aside in between, etc. So matters used to go to the Settlement Commission. But the Settlement Commission to reduce interest or to waive interest and to reduce or waive penalties and to grant exemption for prosecution were gradually whittled away. And therefore, the Settlement Commission has not been as effective in the last few years as it was in the earlier years. Now, the entire Settlement Commission is going to be wound up. And what is going to be done is that short period of time, there will be an interim board which will hear pending matters. The Settlement Commission has discontinued with effect from yesterday. That means even though notices may have been issued for hearing, and let's say for 10:30 a.m. yesterday on the 1st of February, they would have started the hearing and then heard the finance minister speak at about 11:30 or 11:45, and they would have perhaps had to close the hearing or to have it continue by a new body called the interim board. This provision also is not very good because there must be time, and it cannot be that there are so many defects to the Settlement Commission that you have to wind it up on that one day itself, the moment the finance minister utters those words in Parliament. But that's the way this has been done. There has been a lot written in the newspapers and talked about on TV in the case of senior citizens. It is not that the liability to tax of a senior citizen is being reduced. It's just that in certain cases, a senior citizen who is above the age of 70 during the financial year will not have to file a tax return. His liability will still be the same, but he will just not have to file the return. But this is only in very limited cases. Firstly, the person must be at least 70 age at some point of time during the year. Secondly, he must have only pension income, and he can also have interest from the same bank in which he's receiving his pension income. Thirdly, that bank should be a specified bank. So if you're over 75 and you've got two Indian banks and you get your pension in one and you also earn interest from the second bank account because you want to split your holdings. You don't want to be in the position where, for instance, you are with the Bank of Punjab and Maharashtra and all your money gets blocked. Then you will find that you will lose out on this facility. You will have to file your tax return. But if you do comply with all this and the bank is a specified bank which is notified by the government, then the bank will compute the income after giving effect to the deductions under Chapter 6A for instance, efficiencies for which you get a deduction under Section 80G, etc., and rebate under Section 87A, then they work it out and do the appropriate TDS, which may be more than the 10% or 7.5% that they normally deduct, and then you will file, and then you will not have to file a tax return because your calculations hopefully should be very precise. But this will apply to a very small number of persons. This is something that applies to those who are non-resident and have come back to India. There is the 401k system in the US, where a person contributes substantial amounts to a retirement fund, and then when he comes back to India and he becomes resident here, he would have to keep paying tax on the income that accrues from year to year. For instance, if his retirement fund receives dividend. But in America, that amount is not taxable at that time. It is taxable only when you draw money out from the retirement fund. So there is a mismatch, and there is a tax problem to such assessors who were non-resident and who have come back. I faced this situation on behalf of certain clients, and I told them that he had to pay tax even though they were not drawing the money out, even though it was blocked in the US. So here they will now allow such a mismatch to occur, and the tax liability will be postponed. Then this is a strange provision. It talks about dividend to business trusts. It says that Section 194, which provides TDS on dividend, will not apply to dividend paid to a business trust, like for instance to a REIT, to real estate investment trust, or to an INVIT, an infrastructure trust. But this says that this will have retrospective effect from 1/4/2020. Now, if tax had already been deducted in April, May, June, July, right up to January, how can that TDS be returned to the company to give this retrospective effect? Just doesn't apply. It should have been in effect at least in February or later. But this is what is. Anyway, it will be useful going forward, and a REIT or INVIT will not have to suffer this TDS. There is now an authority for advance rulings, and one of the members of that has to be a retired judge of the High Court or Supreme Court. The bill and the memorandum explaining the provisions of the finance bill records this, and I put it in inverted commas. The post of chairman and vice chairman for a long time due to non-availability of eligible persons. That means retired High Court and Supreme Court. This has seriously hampered the working of the AAR. Actually, it was for the government to appoint so many judges who do retire every year, and I'm sure there was a large number, but these positions have not been, and therefore it is true that the AAR takes much more time than it is supposed to under the law. Now they are going to discontinue the AAR, but there will now be a body which will be called the Board for Advance Rulings, not the Authority for Advance Rulings, which will decide such matters. And another difference will be that up to now, a decision of the Authority for Advance Rulings was not appealable by either the SSE or the department. Now it will be appealable. So it will only be advisory in nature, not be binding on the parties. Some of these have been claiming depreciation on goodwill, and this was on the basis, this was confirmed by the Supreme Court in the case of Smith Securities Limited. This position is now going to change, and there will be various amendments to Section 2, to Section 32, Section 50, and Section 55 to provide that goodwill will not be depreciation. If you have paid a certain amount for goodwill, well, you can still keep it in account, and if you have the business, then you may make a capital, get a deduction for the cost, but you will not get depreciation from year to year. Section 143(1) is another provision that relates to intimations of assessments. Without assessment proceedings under Section 142 and 143(2) and 143(3), and I can issue under Section 143(1). Under such an intimation, they can make certain adjustments, but those only have to be things which are apparent on the face of the record. For instance, if there is an addition, there's an error in the addition, that if a person had written 1,50,000 rupees plus 25,000, instead of writing 175, he had written 1,85,000. Well, that kind of adjustment could be made. But now this will be extended, and there will be some adjustments can be made if the audit report shows a higher figure. This would apply to a case where there is a tax audit or a transfer pricing audit. In that kind of case, an adjustment will be possible without calling upon the assessee to respond without a notice being given. Also, the time limit for sending an intimation under Section 143(1) will be reduced from 1 year to 9 months from the end of the financial year. And for issue of a notice under Section 143(2) is to be reduced from 6 months to 3 months from the end of the financial year. So they are speeding up many of these, and therefore proceedings will get over quicker than they did in the past. Provident funds are of different kinds. Many of us invest in public provident funds. In some cases, an assessee is employed with a company which has an EPF. Now, in the case of an EPF, one can put in substantial amounts, because if an employee's salary is high, then there would be a contribution by the employer and a contribution by the employee. In that case, the amount that could go into the EPF account could be much more than 1,50,000 rupees, in which case the assessee was getting high amounts of interest because the contributions were substantial, and there was no tax on that interest at all. Whereas a person who was not in an EPF but only in a PPF would get the facility to contribute only up to 1,50,000 rupees, which meant that there was a limitation on the interest that he was earning. Now, the law will be amended to say that the exemption for interest will be available only if the contribution is up to 2,50,000 rupees on or after 1/4/2021. So even though an employee contributes more or the employer contributes more, the exemption for interest will only be to this extent. In the case of a slump sale, that if, for instance, an entire undertaking is sold, then in certain circumstances, the gain will be treated as a capital gain. Now, what was happening was that in some cases, one assessee would transfer one business to another assessee and take over a business. He wouldn't get money for that, but he would do an exchange. So the definition of slump sale is now being amended to provide that this will include all types of transfers. So even if it is an exchange, that means if it is a barter, there can still be a tax liability computed, just as it is under Section 2, subsection 47 of the Income Tax Act. There was an income declaration scheme introduced a few years ago in 2016, and they had said at that time that excess amounts that you had paid were not refundable. Later, they said that the CBDT would specify cases in which the excess was refundable. So when some amounts were being refunded, then assessees asked for interest on that. Now they have clarified that they will not give interest on the excess refund. They will give you the refund, but not interest thereon. And this is with retrospective effect from 1st July 2016. This is an amendment which affects a very small number of persons, but has been significant and can lead to a lot of litigation. Section 6 of the Income Tax Act was amended last year to relate to providing for the definition of non-residents. And there, one of the amendments was that if you were liable to tax in some other country, then it would affect your status. Now, if, for instance, you are a resident of Dubai, and Dubai has no tax liability at all, then or no tax law at all, income tax law, then can it be said that you are liable to tax? So it says the law is now being amended to say that liable to tax in relation to a person means that there is liability to tax on such person under any law for the time being in force in any country. So if there is no liability in Dubai, then it would mean that you are not liable to tax at all, because there is no tax liability as of now. There has been an interesting provision in the Income Tax Act for some time, Section 44 ADA, which says that if a professional earns up to 50 lakhs of rupees during the year as a gross revenue, he can get a deduction, he or she can get a deduction of up to 50% of the income. Now, this applied to individuals and to HUFs and to partnership firms. It has now been clarified that it does not apply to an LLP. So we come to the end of several of the provisions which have amended the Income Tax Act. But what has not been done? Well, what has not been done in some ways is very good, and some ways is not good. We're very fortunate that the tax rates, that inheritance tax has not been brought in. We are very fortunate that the COVID tax is not there, and because that was a fear that they would bring in tax and that there would be perhaps a wealth tax, etc. But luckily, those things have not been done. On the other hand, I think that several other things could have been done. This has been such a difficult year. This has been such a difficult year for everyone that there should have been some tax benefits. Rates of tax should have been brought down. There should have been some facilities given in payment of advance tax, because in the month of June, no one could predict the income was going to be during the year. It could be that the lockdown could have continued right up to 31st March. In fact, it did continue for so many months more. So many assessees just did not pay any advance tax on the 15th of June. Some didn't pay on the 15th of September. So they would have to pay interest under Section 234C of the Income Tax Act. So I think this kind of thing could have been done. As I said earlier, GST on real estate should have been just completely removed, because this 5% has affected the real estate market, and particularly developers. Because why should a buyer, especially in the flat market, buy now and pay GST of 5% when he will be able to buy the same property later on without having to pay GST? So it's things like these that could have been done. But anyway, we have to accept life as it comes, and we just have to understand our position and move forward to the future. Thank you.
A wonderful presentation. I thank you, sir. It was a very comprehensively about income tax, and Hindani rightly said that we are all so blessed that faculty like you are there in the real estate industry, and for personal finances also very comprehensively made. It was not just what you have suggested that what the finance minister have done, but you have also opined on some of the provisions where it would have actually been improved upon. And if had in finance ministry is listening to us, I believe that the amendments to the finance ministry may take place for a better understanding. I thank Dr. Hirandani for being here on the show, and blessed us for his all wisdom which he possesses, and Advocate Anil Hareshji, who has taken out with his busy schedule and given this. I believe this document is there on our website and also on the YouTube for later on you can see. And thank you very much, sir. Thank you, Ji. Thank you.